Hello everybody, this is Professor Chandana Goswami from Tezpur University. In this video, we will discuss issue management, that is initial public offering, further public offering, offer for sale and private placement. In my earlier video, we had discussed about a merchant banker and its activities. Here we will focus on one of the important activities, that is issue management. Issue management can be divided into two parts, pre-issue management and post-issue management. In a pre-issue management, we are talking of an issue that happens through a prospectus or offer for sale or private placement. And in a pre-issue management, marketing and underwriting of the issue is also involved. So we have different types of issues. Initial public offering, which is the one offered to the public for the first time, and the public can buy these shares directly, of course through the stock exchange. This happens when a company is converting from a private limited company into a public limited company. Then we have a further public offering. So anything that follows the IPO is an FPO. These are the shares offered again to the public either by a public issue or a rights issue or a composite issue. Composite issue means that it is a combination of public issue and rights issue. So FPO is offered to the public through the issue of a prospectus and the public subscribes to them directly. In case of a rights issue, the existing shareholders are given the right to subscribe to the new issue on a pro rata basis. If it's a pro rata basis, it means that the shareholders' proportional ownership will remain the same even after the rights issue. Then you also have offer for sale or a private placement. So it can be summarized through this picture. You see, issue of shares happens through prospectus, offer for sale and private placement. And through prospectus, the route is IPO or FPO. Let us discuss them one by one. For public issue through a prospectus, in order to raise money from the stock market, the company must actually have 3 years track record. So a new company which does not have this 3-year track record cannot access the capital market. However, if this new company is set up by an existing company which has a 5-year track record, then this new company can raise money from the capital market, and it is also free to determine its share price. However, the company issuing shares has to discuss draft prospectus with the merchant bankers. Now, what is a prospectus? A prospectus is defined as a document, and it will also include notice, circular, advertisement, and this document invites deposits from the public and tells the public that you can subscribe to or you can purchase shares of our company or debentures of our company. So this is the job of a prospectus. Every prospectus must have a date, and this date is important because there are certain timelines to be met in doing a public issue, and all your timelines will have a relation to this date of the prospectus. A prospectus has to be created and signed by the directors of the company or any other authorized person. And after it is prepared and signed, this has to go to the Registrar of Companies for registration. Once it is registered with the Register of Companies, the public issue has to take place within 90 days. For private placement or rights issue, prospectus is not required. So what does the prospectus contain? It contains the object of the company. So you must know why the company was set up, what is the purpose of this company. Then the number and classes of share. What are the types of share that you are issuing? Is it a plain equity share or is it a preference share? And how many numbers of shares you are going to issue? There also has to be information about the directors, because any retail investor would like to know who is heading the company, who is guiding the company. So therefore, this information is required. The minimum subscription also has to be stated, that if somebody would like to apply for the shares, what is the minimum number of shares that he or she has to apply? What is the amount payable on application and allotment? Who are the underwriters and what is their commission? What is the voting right? What are the dividend rights in that instrument? Second is offers for sale. These offers for sale are made through intermediary of an issue house, that is the merchant banker or the firm of the stockbroker. The company sells the entire issue of share or debentures to the issue house at an agreed price, which is generally below the par value. Then these shares are resold by this issue house to the public. So in one trading day, the entire shares can be sold off. And in this case, a statement in lieu of a prospectus should be filed with the Registrar of Companies 3 days prior to the allotment of shares or debentures. This offer for sale was introduced by SEBI in February 2012 with the intention of helping promoters of listed companies dilute their stake through an exchange platform. So in this case, the promoters are the sellers. And who are the buyers? That is the bidders. They include all market participants as individuals, companies, qualified institutional buyers, and foreign institutional investors. This facility is available on the Bombay Stock Exchange and National Stock Exchange. But this is not for all companies. Only top 200 companies, and that too by market capitalization in any of the 4 completed quarters, can use this facility. Non-promoters of the company holding at least 10% shares capital can also sell their shares through this route. And in this case, when a non-promoter is selling off the shares, the promoters can act as bidders. Minimum offer size has to be 25 crore. But if the offer for sale is being done with the intention of meeting the public shareholding norm, which means that you have already you have a public issue, your shares are there in the public, but you need to have more of it. So then in that case, the offer size can be less than 25 crore. The company has to inform the stock exchanges at least 2 days before this OFS. And SEBI has mandated that at least 25% of the shares in this OFS must be reserved for mutual fund and insurance companies. And additionally, a 10% reservation is made for retail buyers. Let us move to the third method, which is private placement. So it is a direct sale of securities by a company to institutional investors, and there is no prospectus involved out here. Through private placement, the company can sell shares, preference shares, and debentures. Issuers can be public or private limited companies. And your investors include mutual funds, life insurance companies, general insurance companies, state financial corporations, pension funds, and insurance funds. In a private placement, the investors are assumed to have sufficient knowledge and experience to be capable of evaluating the merits and risks of the investment. The merchant banker plays a vital role in preparing an offer memorandum and negotiating with investors. We said that there is no prospectus, but there is a document called an offer memorandum which is prepared. Private placement has advantages of speed, low cost, and confidentiality. Public issues are expensive, so therefore small companies may prefer private placement route. Through private placement, funds can be raised in 2 to 3 months, while a public issue takes up to between 6 to 12 months. Companies prefer private placement because of the following reasons. Fund requirement may be smaller than the minimum stipulated for a public issue, so it makes sense to go for a private placement. And private placement is not influenced by the bear or bull phase in the stock market. Attitude of institutional investors towards regular issuers in private placement market is more stable and continuous. So those were the 3 techniques. And while we are talking of private placement, the widely used instrument in private placement is non-convertible debenture because it gives stable and assured yield. And private placement is an informal market not regulated by SEBI. So once after deciding whether you would like to go through a prospectus or through a offer for sale or a private placement, the next phase which comes is coordination, marketing, and underwriting. This is specially applicable for public issues. Merchant bankers have to coordinate the activities relating to the issue with different government and public bodies, professionals, and private agencies. Now you have seen that the merchant banker has to communicate with SEBI, has to communicate with the registrar of companies, has to communicate with investors, and merchant banker has to ensure that the information required by the Companies Act and SEBI in the prospectus is furnished. They also have to arrange for drafting of prospectus and vetting it by solicitors. After the prospectus is drafted, it has to be sent to lawyers who will go through the prospectus, keeping the legal angle in mind. They also have to exercise due diligence in ensuring compliance by the company with regard to prospectus. Like they have to get consent of the brokers, consent of bankers to the issue, consent of underwriters, consent of legal experts, and all that. Only after clearance from SEBI, the prospectus can be filed with the registrar of companies. So in a public issue, you have to appoint brokers to the issue. And why do you need brokers? Because they are going to canvass subscriptions for you. They are going to do the publicity for you, and they will inspire confidence among investors. We also require bankers to the issue for accepting applications along with the subscription, then forwarding them to the registrar or the issue house, and also undertaking publicity. Then the merchant banker can do on its own or maybe appoint a registrar to the issue or a issue house. If the merchant banker is unable to attend to post-issue management activities, it appoints an outside agency for the purpose. This agency has to be authorized by SEBI to act as a registrar to the issue. Such authorization is valid for a year and has to be renewed annually. Then comes marketing the issue. So after dispatching the prospectus to SEBI, merchant banker, company representatives and advertising agents sit together to decide on the following. That what will be the dates for the issue. An issue can last between 3 to 10 days. Then registration of the prospectus, because once it is registered, the public issue has to be completed within 3 months. And finally, launching of a publicity campaign. The timing of the issue is important and is affected by these following factors. Number 1, state of the secondary market. Is it a bull market or a bear market? Number 2, number of other issues in the market. You would not like your issue to be one among the many other issues, because then you will not get enough investors. And if you don't get enough investors, your issue is going to be undersubscribed and that issue will be then made null and void. Number 3, proximity to festival time. In Indian culture, we have certain festivals where we make it a point to buy gold, silver and all that. And during this period of time, I don't think we will go and buy shares. So therefore, proximity to festival time must be kept in mind. Number 4 is the tax payment time. Of course, it is understood that during tax payment time, you will not have much investors shelling out money to buy shares. Number 5 is proximity to time of refunds from previous issues. Everybody who applies for shares may not get the share. So in that case, the money is refunded to the investor. So which means that after an issue is over, within 7 to 14 days, these investors who do not get the shares will get their money back. Alright, so which means that these investors now have their money in hand. So if you can time your issue like this, where the investor has money in hand, maybe you will have a better chance. Then comes publicity campaign, which means preparation of all publicity material, brochures, prospectus, announcements, advertisements, hoardings. And the merchant banker plays a key role in helping in the choice of media. It also arranges conferences at potential centers to explain the nature and strength of the project to various cross-sections of investors and their counselors. Publicity material has to be available at least 21 days before the issue opens. Then comes underwriting. So this is a contract between the merchant banker or a financial institution with the company who is issuing the shares. In case the issue is not fully subscribed, underwriters agree to subscribe to a portion of the capital to be issued. It means that if it is not fully subscribed, the underwriters will buy the portion which is left out. because you don't want the issue to be undersubscribed. In case of a rights issue, it is known as standby assistance. So this same thing is referred to as a standby assistance in case of a rights issue. Maximum liability of the underwriter is restricted to the amount underwritten by him. So therefore, when you are preparing the contract, it is very specifically mentioned what is the liability of the underwriter, and the underwriter will oblige only that much, not more. In respect of every issue to be managed, the lead merchant banker holding a certificate under category 1 shall accept a minimum underwriting obligation of 5% of the total underwriting commitment or rupees 25 lakhs, whichever is less. So these were the things associated with the pre-issue part. After the issue, there is allotment and dispatch of shares to be done or refunds to be given, and then the listing requirements. So let's discuss post-issue management. Prospectus was the invitation, the application was the offer, and allotment is the acceptance. So after the issue, we have to reconcile total applications collected by the bankers with total money collected. Applications with technical defects or which do not conform to stipulated conditions are removed and rejected. Basis of allotment is discussed with the stock exchange and the issue house. After the closure of the issue, the bids, that is the applications received, are aggregated under different categories: firm allotment, qualified institutional buyers, non-institutional buyers, retail. The oversubscription ratios are then calculated for each of the categories as against the shares reserved for each of these categories. Again, after you have these categories, you further segregate. Within each of these categories, the bids are then segregated into different buckets based on the number of shares applied for. The oversubscription ratio is then applied to the number of shares applied for, and the number of shares to be allotted for applicants in each of the buckets is determined. Then the number of successful allottees is determined. This process is followed in case of proportionate allotment. In case of allotment for qualified institutional buyers, it is subject to discretion of the post-issue lead manager. I will just show you an example 2 slides later, then you will understand how exactly it is done. In the present allotment system, one lot has to be worth between 10,000 to 15,000. Earlier it was 5,000 to 7,000. Minimum allotment of one lot to all retail applicants wherever possible should be done, and the balance shares to be allotted on a proportionate basis. But in case of huge oversubscription, the lottery system has to be followed. So this is the example which will make it clear. So you have the CSB Bank where the minimum bid lot was 75 equity shares. Alright, so anybody who is applying has to apply for 75 equity shares. So the quota for retail investors was 18%. Alright, so which is 21,906 shares. The issue was oversubscribed 44.53 times. So in that sense, there were retail applications for 935,51,025 shares. Now how do you distribute this? So what you will do is that 21,906 shares that were reserved, you divide it by 75 shares because 75 is the minimum lot kind of bid. That translates into 28,012. That means 28,012 retail investors will get shares. The rest will not get. Okay. So like this, to 28,012, if you multiply by 75, it comes to 21,900,000. So that went off to the bidders, and the remaining 6 shares were allotted based on lottery. So after the shares are issued, or like a refund has to be done, so within 30 days of the close of the issue, you will dispatch the share certificate and the refund order. And within 2 working days of finalization of this basis of allotment, all allotment and listing documents have to be submitted to the stock exchange. And within 7 days, all listing formalities have to be completed and trading has to commence. So this was about issue management. The next video will cover portfolio and investment management and corporate restructuring. Thank you very much for tuning in.